Hey, it's Elena of Financialdemics, and we are going to talk about ways you can legally reduce your taxes. Now, I know you may be thinking like, what do you mean? I already filed my taxes. Well, it wouldn't have mattered anyway because your taxes were for last year. So I'm going to tell you things that you can do for this year to reduce your tax liability and possibly put you in a better situation overall when it comes to your finances. Now, I know most people, they hate taxes, right? They hate paying taxes. They hate that they have to file taxes and all of these other things. At this point, let go of the things you cannot control. You got to do it, just do it. We do a whole bunch of things we hate to do every day, but we still do it, right? So when it comes to your taxes, the best thing you can do is put yourself in the best situation possible, which is making sure that you know these tips and implement them so that you're possibly not paying as much taxes later. So the first thing that you can do to legally reduce your taxes is contribute to your 401k or traditional IRA. Now, the benefit of contributing to your 401k or your 403b at your job or to a traditional IRA is that both of these items help you reduce your taxable income, but then they also grow tax-free until retirement. Now, I know everybody loves the Roth IRA. The thing about the Roth is that it's considered that you contribute to that after tax. So the amazing thing about the Roth is that it does grow tax-free, but it does not reduce your taxable income in the year in which you contribute to it. So that's why I'm specifically mentioning the traditional IRA. Now with your 401k or your 403b or your 457b, those particular retirement vehicles, you are able to contribute a lot more than you typically would be able to contribute to a traditional IRA. An IRA has a lower contribution limit than your employer-sponsored retirement plans. So with those employer-sponsored retirement plans, you're able to contribute more, but then also your contributions to those type of plans reduce your taxable income dollar for dollar. So for example, if your income is $50,000 for the year and you have contributed, say you've contributed $10,000 to your 401k at your job, then that can easily bring down your taxable income to $40,000. Your liability is less, which puts you in a better situation. Regardless of the fact if you owe or if you get a refund, it's going to put you in a better situation because you're not going to be taxed on the same amount of income, and that income that you put away is actually growing, participating in the market for you. So that's your money later. So either way, you get to keep more of your money. Another way to reduce your taxes legally is by contributing to a health savings account. Now, if you are eligible for a high deductible health insurance plan, then you are eligible also to open up a health savings account. With that health savings account, you can contribute to that health savings account to help offset that high deductible. But then also, because you are contributing to that health savings account, those contributions are considered pre-tax contributions, which would also lower your taxable income. And another benefit is that the funds in your health savings accounts grows tax deferred, and they can be withdrawn tax-free if you're using them for qualified medical expenses. So that's a win-win if you use the health savings account properly. And I also want to mention that with the health savings account, you don't have a deadline to use the funds, so the funds just roll over. So you can literally contribute to a health savings account as long as you have this high deductible plan until you reach retirement. And another benefit of the health savings account is that you don't have a deadline to take the funds out like you would for the flexible accounts, so that balance rolls over. Another way that you can actually reduce your taxes legally is by contributing to a flexible spending account for your medical expenses or for your dependent care expenses. These are two different accounts that are typically available through your employer, and the contributions are considered pre-tax, so they actually reduce your taxable income. Now, the difference with these two accounts is that one is used for qualified medical expenses and the other one is used if you actually pay for dependent care for either for your child or maybe an older disabled adult. The funds grow tax-free and are withdrawn tax-free if used for qualified medical expenses or for dependent care expenses. Now, the difference between the flexible spending accounts and the health savings account is that the flexible spending accounts do have a deadline in which you have to use the funds. So it depends on your plan with your employer. I'm going to say check with your employer because I've seen some that have to be done by the end of the year. I've seen some that have a little bit of an extension through a certain date in the beginning of the year. So check with your employer, see when's the deadline to use it. But if it's something that you can possibly take advantage of, then definitely check into that. And I will also mention that with the health savings account and the flexible spending account, typically those you have to enroll in during enrollment season, but check with them anyway because you might have had a qualifying event that'll allow you to get into them, or some employers may be a little bit different with their rules. So always check and see what your employer allows you to do. So if you're currently in school, either to get your education or to advance at your job, then you definitely should look into the credits for paying for higher education expenses. One of them is the American Opportunity Credit. You can only claim the credit for 4 years and it's up to $2,500 per student. And then there's also the Lifetime Learning Credit, which that credit can be, of course, claimed repeatedly as long as you are in school, you've received a 1098T from your from the school that you're going to, so that you have that proof that you are actually paying those expenses. But that credit is up to $2,000 per student. Another way that you can legally reduce your taxes is just through an action that you probably don't even think twice about, and that is through charitable contributions. Now, if you are a person who typically takes the standard deduction, then you'll have to check and see if, you know, those contributions are available for you. You know, laws have been changing rapidly recently, and so a couple years they were available, but we don't know if they're available going forward. But if you are a person who itemizes your tax return and you also give charitable contributions, cash contributions, then you may be able to write off those contributions. You also may be able to write off the contributions when you return tithe to your church. So make sure that you are getting a receipt if you are attending a church, or if you are, you know, contributing cash contribution somewhere. Make sure you know, keep a copy of your receipt so that you can possibly write those off if that is available for your situation. If you own a business, you can also write off your business expenses. Now, they need to make sense according to how much income you've brought in. But if you have expenses that you pay for to run your business, to get your business started, then those expenses can be possibly written off on your taxes. You definitely, if it's not your forte, you definitely want to speak with an experienced tax preparer, maybe an enrolled agent, or either a CPA, and they'll be able to talk to you, guide you through the process. You probably might want to let them handle your return because they know what to look for and what to ask you. Sometimes when you do it on your own, and I'm not knocking doing it on your own, you know, if you're knowledgeable in that area, you've done the research, then yeah, but they'll know some things that you don't necessarily know. and ask you some questions that can help you get the appropriate write-offs. You also, if you have a home office that is a dedicated home office, meaning like that room in your house is the only use for your business, then that also can be a write-off. Again, you want to make sure it's a dedicated home office. It can't be like a home office slash guest room. It has to be a dedicated area, but that's also a way that you can reduce some of your taxes during the year. I also want to mention, this is not tax advice. These are things that I'm mentioning to you that you can look up yourself. It is easily available on irs.gov to see the different allowable write-offs that are available to you. Also, if you have someone who actually helps you file your taxes, you can go talk to them and find out what's available for you. For the options that are available through your employer, definitely go talk to your employer, because your employer can give you the best information that they have available for you, because everybody's benefits plans are different. Like the benefit plan at your employer is going to be different than the benefit plan at my employer. If this was helpful for you, please give it a thumbs up and share it with your friends so that they can also benefit from reducing their taxes legally. And I'm going to see you next time with an all new video.